we are fortunate to have a person who is an expert in M&A world, accounting world, and then us here from Ballast. So I'll introduce myself so that maybe everybody can just kind of give a background of their company and what you guys do. I'm Andy Reynolds, COO, financial advisor here at Ballast. I'm a CFP, MBA, and I have a accreditation as Certified Exit Planning Advisor, which means help people plan to sell their business one day.
Hi, I'm Tyler Garrett with Benchmark International. We're a global sell-side mergers and acquisition firm. I'm based out of our Nashville office. We've got about 14 offices domestically and internationally now. We essentially represent lower to middle market businesses through an exit. I don't know how much detail you want to go in now, just quick intros or...
Perfect.
Andy Demoss, I'm with RFH here in Lexington. We're a Lexington firm. I've been a CPA for about 20 years now, so but I work with all kinds of small businesses. Have worked with businesses that are from $1 million up to $60 million sales. So seen a little bit of everything.
I'm John Boardman, CEO of Ballast. I am a certified financial planner and a certified private wealth advisor. I always get that acronym wrong. And what does that mean? Basically, whenever we're dealing with a client, prospective client, we do what they need. We don't have like a pre-built plan or portfolio or estate plan, whatever it may be for each client. Everything's custom here, and we love working with business owners, and that's why we're doing this tonight. They have the financial complication that I think can benefit from experts like us and our network of experts that we always bring into the fold. We think that's the one thing we do really well is we know where our expertise begins and ends, and so that's why these gentlemen are here with us tonight. Thank you.
Cool. Thanks, guys. So the invitation, first question, I'm going to give it to you, Tyler. And then we want this to be beneficial to you guys, so just ask questions, raise your hand, chime them out. We're hoping this will be conversational with us. Ultimately, we want you guys to get out of this what you're hoping to hear or learn, so feel free to ask questions. First question, Tyler. So when we think about, you've represented a bunch of businesses, you've seen a lot of businesses in multiple different industries. Talk about what, from the buyer's perspective, what makes a business more attractive than another? Ignoring the industry side, but what are buyers looking for with businesses, and what's something, maybe certain criteria that buyers will want to see that will make them pay a premium for a business that may otherwise would not have?
Mm-hmm. Well, taking a little bit of a step back, normally the first thing they do is they do look at the market and the sector, and the first thing they ask is it a growing market, is it an expanding market, or is it a contracting market? Is it a cyclical market, or is it recession resistant? That's typically what they look at first. And then from there, when they start to zero in on a business and they really start to look at it more specifically, they really want to see, what are the defensive characteristics of the business? What's the moat around the castle, if you will? They really look for that specific IP. It doesn't have to be, true intellectual property, but what are some of those technical know-hows about the business that's going to make it last and make it sustainable and growth? That's one of the key factors. Secondly, they really want to look at the management teams. Most of the businesses that we represent are, the CEO is the owner and the founder, and they really want to see the breadth and the depth of that management team, and how much can that management team take that business without the owner. Are all the client relationships relying on that one owner founder, or is the management team really involved? From there, they start to look at obviously financial attributes. They want to see how quickly businesses can turn a sale into cash, and how well they manage their balance sheets. It's certainly a key attribute. Yeah.
One thing I always, I wrote this down just to make sure I said this correctly, but four C's, so 4 different capitals that make your business valuable. So being the human capital, the people, you have people that are better than others. social capital, the culture, what's the business like? You know, if you think about just retail, some businesses are different than others. Structural capital, so the systems in place, can one company do it better because they have something behind them? And then customer capital, so the value of the customers, who they represent, who they're able to sell to. You know, those being big drivers of value for a company.
I want to add one thing to what Tyler said. You know, whenever we're sitting down with a business owner, I like to ask them, you know, you say you own a business, but do you own a business, or do you just own a very complicated job? You know, if you walked out the door, would the business still run without you? If the answer is that it would not run without you, you probably just have a very complicated job that's made to look like a business. And I would think, you know, when you're trying to sell something like that, when they find out that, you know, that person who wants to leave is integral to the operation, then all of a sudden the value is considerably less.
Exactly. It puts a lot more risk on from an investor standpoint.
Yeah.
Absolutely.
Yeah.
Andy, talk about, so when we're looking to sell, so we're talking about how we can make our business more profitable, you know, diversifying customer basis, not making it incredibly reliant on one person or the founder or the namesake of the company. So that's a lot of things we can do from the business side, from the accounting side. So let's say we are nearing a sale. How can we make it a more profitable sale and retain more of what we get?
Right. So yeah, the goal is the most cash into your pocket. So the issue is that, one, minimizing your taxes, and there's different ways to do that depending on the structure of the sale, and I think we'll talk about that here in a little bit. But if there's estate planning that needs to be done, and just the structure of the sale in general. But also not waiting until the last minute when you're ready to walk out the door tomorrow or a year from now. You need to kind of get ahead of it.
Yeah.
And I've seen that quite a bit, where people are tired of working and
They're done.
They're done, and well, we don't have a plan.
Yeah. We, I mean, we talk all the time that, you know, we get new clients, and typically it's, if we would have just gotten in front of them 6 months, a year ahead of time, we could have really helped change something, a decision they made. But it's typically kind of that last moment, you know, I'm done, and you know, there's some statistics I wrote down here as well. 78% of business owners prior to selling never had a strategic idea of how they're going to sell, and they just come to Tyler and say, I'm done, here I go. Or you know, they find somebody who's willing to buy and kind of just find a price and go from that.
And even worse, you know, to the point of waiting till the last minute to sell, some people, and we see this in the professional industry specifically, is they'll grow their book of business and their revenues and their profits, and then they get to a point of comfort, and they tend to slow down their interaction with the business and their activity with the business, and because of that, it starts to dwindle. And so when the buyers start to look at the numbers, they're like, yeah, you had momentum up until 3 or 4 years ago, but where's the momentum gone? Well, that person was spending more time in Florida in the winters, or whatever it may be. Buyers don't care. The reality of the business is what they're buying at the time, and they may think that they're catching a falling knife at that point, that this business is actually in reverse. And so, you know, when the teeing the business up for sale, I think is really important to making sure you have that positive momentum going into it.
Yeah, no, I agree. Not to get too complicated, but kind of digging into the sale. Talk about an asset sale, you know, versus stock sale, and why somebody selling may want one over the other, and why a buyer may want the opposite.
Sure. So a stock sale is, you know, you're selling your company. You're selling the stock that you own in that company, and let's say you get $10 million for that company. You have a basis in your stock, just like you would IBM or any other stock, and then you personally have a capital gain on that sale. If you were to have an asset sale, they're going to buy all the assets of your company, typically all of them. Your capital assets, a lot of times your inventory, receivables, and those get valued based on an agreed. There's a form that both the buyer and the seller have to agree to, and then the rest of the price gets allocated to goodwill. Typically, most buyers want to do an asset purchase because, one, you're not incurring all the pre-existing liabilities that existed, I don't know, for however long you've been in business. Two, they can get some quick write-offs, depreciating the assets. In an asset sale, typically also, as I mentioned, you have goodwill. Goodwill is amortized for 15 years. And for the buyer, they don't want as much assigned to goodwill. For a seller, they prefer that because they get capital gain treatment on goodwill. So there are conflicting sides to that. I've seen both. I know an asset sale is probably pretty more prevalent, though.
Yeah. Do y'all have any experience of negotiating that between a buyer and seller and having to deal with both sides?
Occasionally, but most of them are asset sales. Yeah, for the markets that we're in.
Yeah.
Yeah.
I'm dealing with one that's an equity set. They're a stock sale right now, and you asked me earlier about a Q of E, quality of earnings, and not only are they having to go through that, but as I mentioned, the liability that's out there. There is, when they're buying the stock, they're buying all the liabilities, tax liabilities, all previous sales, warranties, depending on the product. There's a lot more that the buyer is really going to want to go through and be ready for when you do that stock sale.
Yeah. John, you've talk a little bit about, you mentioned estate planning and some different technical things you can use without getting too advanced, but talk about family limited partnerships, how to, if we're thinking about how to maximize the value of our business, but then retain the maximum amount of our business. What are some things that we've done hereabouts?
Yeah, and this is something that really has to be done in advance because the IRS will if you try to do a lot of maneuvering right before a sale, the IRS could challenge it. So you have to think through this quite a bit early. So if you think about a business that is profitable, let's just say you own that business and you're anticipating selling it in the next few years and you think it's going to be a windfall to you. At that point, you have capital gains taxes or ordinary income taxes that you're going to have to pay. If it's a real windfall and you have a significant infusion into your household, you would have potentially an estate tax issue, meaning that whatever you pass to your next generation could be subject to tax. So what we've helped some clients do with counsel is think about, is there some percentage of that business that we could allocate to maybe a trust for children or grandchildren, or donate it to a charitable fund where they might receive income off of it for the rest of their lifetime. And in doing that, the ownership at sale looks vastly different, and the taxation of that also can look vastly different. And we have a shining example in our client base where we did this, and it happened much quicker than we anticipated, but it was in the biotech space, but it was essentially a scientific breakthrough that this person and his group had come up with. We actually gifted about half the ownership of it to the kid's trust. It was valued at $30,000. 2 years later, that $30,000, well, the $15,000 they gifted was worth $12 million. So all that $12 million is now out of his estate. That's an unusual situation to happen to that magnitude, but probably saved that family about $5 million in estate taxes in current dollars. So you can do these things. You just have to think through it. But anyway, there's any number of things you can do, but it does require a lot of advanced planning and advanced time to make it work.
And I think that a key takeaway is start early. So I would, you may be a little bit different, but from all of us, like I would definitely say like we want to be involved early on and helping plan through it. You guys probably do as well. But the earlier that professionals can be, on the team working together, I think that there's always a good outcome with that. One thing I wanted to share that is in these packs, can I borrow this for a second, this piece of paper? This is a process that we've taken people through, and we'll kind of transition a little bit here in a second to what some of this chart means. But it's really one thing that we've noticed, and again, this comes back to starting early, is a lot of people, when they're going to sell their business, it does kind of come down to that one day, it's just like, I'm done. Like, I can't tell you how many people have said, and now I've had the experience of working with people long enough, like, I can work till I'm 80. And then all of a sudden they get to be about 58, and they're like, I'm done. So working through these 3 different areas, your business side, your financial side, and then your personal side, I think, business, the one thing I've always thought is business should always be a plan, like John was mentioning. If you're not working on your business is probably dying. If it's not growing, it's dying. So you should be always continuing to work in your business. And these gates, and if you want to know more about this, I'm happy to talk to people in more depth. But basically, it's qualifying your business and trying to figure out where you fall relative to your peer group, and effectively always trying to be the best in class in your peer group. And if you get there, then it's either choosing sell or grow further and advance grow. So grow in a whole nother layer. So if you become best in class in Lexington, maybe the next step is best in class in Kentucky, or a new venture, but continually trying to grow your business, because if you're not doing new things, your competition's probably catching up, or you're getting tired and whatnot. Financial, this is what we do. The middle part's the core of how we work with people, and then the bottom is one that you guys can probably all attest to this. Very few people think about themselves. Your business ends up being your life. You spend so much time in your business and doing your business. I think there's statistics, 80% of people who sell their business a year later, they wish they didn't sell their business. If you think about that, like how much time you put into it, mental energy, it's not just the 8 to 5. You're putting a lot of energy, and you get a lot of fulfillment out of that. So going through these 3 concurrent paths is something we really try to work with people on, and again, getting in early to do that, I think, is really advantageous. So if this intrigues you, come talk to me afterwards, because this could take an hour to explain. But I think it's something, it's a path that you could really work through to help keep you on track from 3 different areas of your life. So let's try. Any questions at this point? I know we've been a lot of talking. Mike?
I have a question just about the stock versus asset.
Sure.
Like, can you explain how that relates to like the QSBS stuff? Like, if you're trying to get the qualified, whatever, C Corp, you hold it for 5 years and sell it and eliminate some of the capital gains, does that have to be a stock sale?
You mean if you were a C Corp and you've transitioned to S and...
Well, I think you have to transition to a C Corp, right, and then hold it for 5 years to get the capital gains relief. I may have that backward, I don't know.
Yeah, I'm thinking the other way.
The S Corp?
Mm-hmm.
That might be right, yeah, I don't know. But would it have to be a stock sale at the end to get the...
You can get capital gain treatment either way on the sale of the stock, S or C.
Okay, yeah, I was thinking there was some like QSBS that was, where if you convert to a C Corp and the value is less than some number and you hold it for 5 years, then you get some capital gains exclusion up to $10 million
Okay.
for 10 times your basis.
I haven't been involved with that, so
Okay.
I can't answer that.
Okay, yeah, I was just curious.
Yeah.
We'll do some research. We'll get you an answer.
Yeah. Luckily, not too many of my clients are C Corps, but we still have a few.
Yeah.
Tyler, talk about private equity. I don't know how many people have entertained private equity, thought about private equity, but talk about the state of private equity. I know it's changed a lot over the past several years. So where, from what you guys are seeing, where's private equity at right now and looking forward?
Yeah, it certainly has changed quite dramatically over the past 5 to 10 years. You know, we're seeing a lot more private equity funds, a lot coming much further down market than what they had been historically. And from a buyer standpoint, you know, from us being sell-side advisors, traditionally our buyer pool is normally about 65% private equity and about 30 to 35% strategic buyers. And you know, the last 12 to 18 months, you flip that completely around, and we've been seeing a lot more strategic buyers. That's due to the fact where interest rates are at, the cost of capital. Private equity comes to the deal table with a lot more debt, a lot more leverage. We've certainly seen them pull back over the past, you know, year and a half. The sentiment out there that rates are coming down, there's going to be a cut, who knows when or how many, that's a whole nother topic for another day. But that's really sparked the interest to get private equity back to the table a lot more. What we've seen this first quarter in 2024, there's still a tremendous amount of dry powder on the sidelines. They're really starting to get a lot of pressure from their LPs to start deploying some of that capital. And we're just now starting to collect a lot of the data from 2023, and we're seeing that fourth quarter in 23, they had you know, phenomenal fundraising and capital raising efforts in their funds. So there's still a tremendous amount of that capital being sent to these funds. So we're gearing up for these funds to really get back to the deal table, which should be good for sellers. Really, for the first time, we've seen strategic buyers outbid private equity, which has really never been the case.
Yeah.
So that it should really help the market overall quite dramatically.
And strategic buyers being buyers who can buy a company that tucks into them and can help them either grow or help them go into a new market.
Exactly, a similar player in the industry, either private or public, or some type of subsidiary that's closely related to that target.
Yeah. Yeah.
And private equity, you know, people may think that private equity is not a potential buyer for their business, but you would be shocked at the industries now that are getting calls from private equity companies to acquire them. I mean, we're seeing this actually in the medical professional space right now. Dermatologists, plastic surgeons being bought out by private equity firms. Like, that's something 10 years ago no one would have even envisioned. So to his point, there are so many funds out there, and they're looking for good industry where they see solid annual returns and recurring revenue. It's everywhere.
It is, and it's much more competitive too, and that really drives the value up from a seller standpoint, because the seller's really in the driver's seat, which it never really traditionally had been when they're going up and negotiating against private equity. There's a lot of funds out there that are making minority investments, and they never would have done that in the past, or they're coming to the deal table with a lot more creative structures. You know, typically we would see, you know, the best fit for private equity for our buyers is when the owner does want to stay on for a certain amount of time, whether it's 3, 4, or 5 years, and they want to be closely affiliated with that business. There's a great rapport and great alignment between the ownership group and the private equity, and he wants to stay on for that wave. He might want to take a little bit of the chips off the table and have that back office support.
I've seen that work really well, and I've seen it not work not so well.
Yeah.
Sometimes the promise is made before the purchase, or not the promise is fulfilled after the purchase. But,
Sure.
So it just requires a lot of due diligence by the seller.
Exactly, and we typically see that whenever sellers don't have the proper representation and they go at it alone and they don't have the right advisor behind them. You know, going back to your original point about, you know, preparation and getting in sooner, that's one of the biggest mistakes we see with our clients is, you know, they're not prepared, and most high value businesses, whether it's in the lower market or the middle market, should always be market ready. You should always have updated financials. You should have your SIMs built, your confidential information memorandums, your teasers, all your pro formas and financial models and projections and forecasts. All that should really be ready. So when you are approached, you're ready to have a serious conversation. Normally we get the call and they say, Tyler, I got an LOI from a private equity. You know, it's a lot lower than what I expected, but what do I do? You know, and they're nowhere near being able to have like a true meaningful discussion, and they already opened up their books and kind of showed them everything, and they're left dissatisfied with that LOI. There's a lot of preparation, a lot of work that goes on the front end to prepare that business, to get it ready to even show them for potential acquisition.
Talk a little bit about what that experience looks like through you guys. Mm-hmm. So, you know, I come to you and I'm interested in selling a business, how does that process look like, and what's the deliverable on the back end?
Yeah, so we look at it as a partnership. It's a deep-rooted collaboration between us and our clients. And first and foremost, we need to learn everything about them personally, what their goals and aspirations are, moving forward. Then from there, we could start looking at the business, all the background and the basics of the business. And then we start a very comprehensive, detailed approach to going over all the products and services they provide, everything from their entire client base, their top clients, their retention rates, what markets they serve, what's shifting in those markets. We prepare very detailed market analysis for all the different regions and different sectors. And then from there, we're looking at pretty much all their financials, obviously income statements, bank statements, tax returns, cash flows. We want to look at their competitors. It's a really detailed process that really takes about a month for us to collect all that data and really start preparing our presentation to get it ready. Those are just a few things. I mean, I could go on. I'd be here all night. But it is an extensive list. It does require the seller to, like I said, collaborate. It's a pretty heavy lift on the front end, and we certainly know that our clients have to do this while they're still operating their business as well. So we try to make their life as easy as possible, but the sooner we can start collecting all that information and understanding the full operational aspects, the sooner we can start building out all that material.
What are some common themes among those transactions that you see not get over the finish line?
Yeah, it's a great question, and it typically comes to that due diligence process whenever something's discovered, when they really dig a lot deeper in those financials, and they don't have somebody like Andy here who has professional financials in order, audited financials. A lot of the businesses we work with, they don't have really comprehensive, in-depth annual budgets and forecasts, and they don't have audited financials. And we've seen private equity, just due to where we're at in the market, their due diligence process is a lot more stringent than what it has been in the past. I mean, deals are taking a little bit longer to close through that due diligence process. The banks are looking at a lot more statements than they would have traditionally. So typically, it's something is found in those income statements where it calls a red flag for private equity to pull back a little bit, or even on the strategic side. So it goes back to the preparation, have your financials in order. The sooner that we can get engaged and build out those pro formas and models and scrub those financials, we'll be prepared for it. But that's typically what it is. At the last minute, something comes up.
One of my clients, they've had good financials at the end of the year. They've had audits at the end of the year, but their monthly financials are just garbage.
Mm-hmm.
I mean, what they're producing, they're not tracking stuff throughout the year, and it's really been a headache to try to produce what's needed for as part of the sale. So that's another thing to get in front of.
And people are thinking they're saving money, probably not having a professional
Right.
do their books every month, and then it comes back, it's costing the deal.
Yeah.
How much, just curious from the private equity, so they're getting a little bit more, intense on looking at the financials, looking at the P&Ls. So the benefit of being a business owner, which everybody probably knows, is there's some flexibility in what you can pass through your business, and a lot of business owners will recast their financials, taking some of that stuff out that maybe if this was run by a PE group, or if this was run by a different owner or a strategic buyer, these things could fall out.
Mm-hmm.
How much nowadays are PE groups willing to look at a recasted balance sheet, not balance sheet, but P&L, taking that stuff out? Or would they rather see it gone?
Yeah, well, that's why it's better that we get in sooner and we can adjust those, make those adjustments, put those add backs on. If you've got, your country club fees and 3 different cars in the business and everything, we could add that back in and adjust that EBITDA to where it really should be. And I was going back to my original point where, business owners are approached and, they hear all these amazing things that private equity group is telling them about their business, and they open up their books and then they end up getting an offer that they're not satisfied with. And then at that point, it's really too late. It's really hard to negotiate at that point. That's why we like to get in early, scrub those financials, present it the way it should be presented, and also take it through our entire process into the market to really capture all those, all those additional buyers to really drive that competitive bidding process up. If you're trying to negotiate with a private equity group and they know that they're the only buyer. You're not going to get anywhere. You really want to come to the deal table with, with a lot of leverage and a lot of ammo, if you will.
So the key being not wait till the last moment.
Exactly. Yeah.
John, I want you to talk about a little bit of things. I'm not going to give the exact example, but we have a client who, let's just call it a textbook industry. It wasn't. But think about textbooks. You used to buy a lot more textbooks online, or a professor would print something out and you'd have to go get it. That industry changed pretty quickly. This one industry client bought a business for almost $1 million, doing XYZ. Industry changed. All of a sudden, they're getting paid about 10% of what they were getting. So a lot of our business owners, their biggest asset is their business. Rightfully so. You're putting sweat equity in the business. Your return on some of that money can be a lot better than what it would be in public markets or whatnot. Talk about how we balance an asset of a business with doing other things outside of that one asset in case something doesn't work out.
Yeah. But yeah, I think it has a lot of benefits. You can de-stress your life a lot if you know you have something else accumulating outside of your business, for sure. I think I've worked with entrepreneurs, business owners over the years that they own a business in a certain area and then they invest in the exact same thing outside of their own business in the same space. That's not really creating a safety net for themselves, right? If that industry has issues, they're investing in peer companies, whatever it may be. I think at the very beginning, early on in a business, most every entrepreneur, their personal and their business financials tend to overlap. It's hard for them to keep them separate. So I think as early as possible, if you can have your work wallet and your personal wallet, I think that makes a big difference in not only how you make business decisions, but personal decisions. But if you can accumulate in other ways along the way, and ideally in a way that sort of offsets the risk that you have in your own business, that's hugely beneficial. Speaking to everything that's been said up here about preparing early, sometimes life just throws curveballs at you, right? It could be your personal health, it could be your family situation, whatever it may be, that requires you to come to the table to sell your business quicker than you had anticipated. Life, I'm sure everyone in here, their life has gone exactly as they planned every day. But for others out there, life can throw curveballs and you might have to sell it 5 or 10 years early, or you're just at a burnout place in your career where you decide, I thought I had another 20 years, but I was only able to give it 10 more. So I think preparing yourself with the organization and financials and all of the things, that's a big part of it. And it's just, you don't want to plan for the worst, but you just have to be realistic that there are risks that exist out there. So if you're, taking out a lot of personal debt as it relates to expanding your business, just be conscious of what would happen if you were out of the picture. The family members that you have that are relying on your income, or the debt that could potentially be absorbed by your business partners. These are all things that no one wants to talk about, but they happen every day. And unexpectedly, people are having to sell businesses for discounted levels because they're not organized, or there's financial devastation to the business because one partner passes away or becomes disabled. So there's a lot of things. I think that's any number of things you could do.
I think one thing, I can't remember where I heard this, maybe in you, but try to plan for a lifestyle that you would be comfortable with if your business failed, or if you didn't get anywhere near what you thought you were going to get for your business. So, I think as business owners, you're very confident in your business. I was asking you earlier, in my experience, most business owners think their business is worth a lot more than it's actually worth, and that's okay.
It's like their house.
It's like their house, or their beautiful dog or beautiful baby. They're all beautiful. But if you can have something else going so that if it doesn't work out the way you think it will, we still have a decent next best option. I think that, to your point, also de-stresses the anxiety on this. This thing has to work, and then you start chasing opportunities that may not.
I mean, we
as-
saw it during COVID. I mean, even with
Yeah.
PPP, I mean, the number of bankruptcies that happened during that period was really terrible. And I mean, it was clear that, I mean, and a lot of, like, particularly mom and pop businesses, they operate on a razor thin margin. If one month, 2 months in a row that are ugly, and they could be close to being out of business. And that doesn't just happen to small businesses, though. It happens to large businesses too. They get complacent and overconfident. Economic conditions can change in a second. So I think there's any number of things you can do to protect yourself. But I think the de-stressing that I've seen in client, that's probably the biggest benefit, is that it allows them to think long-term with their business and not have to worry necessarily about short-term cash demands that the business might have.
I think having those two different hats, you wear a lot of hats as a business owner. Put your business owner hat on, and then put your family member hat on
Yeah.
too. You have other people who rely on you to not be walking around, broke or stressed out. Neither of which are good. So we've talked. Common theme: start early, planning. When you guys, and maybe everybody can chime in, when you think back to the clients you've worked with who have sold their business, gone through all this, and I'm sure we all have happy ones, I'm sure we all have less happy ones. What do the common themes look like? If you paint a picture of these business owners that sold, they're happy about the way life went, what does their life look like? And this is a rosy question, not a numbers question. Like how would you describe those people? What else do they have going on in life?
I talk too much.
From what I've noticed and what we do, it's really finding that right partner, that right group to really spend the next couple of years with. Most of our deals are structured where there's some form of equity rolled over, and they're going to continue to operate the business and lead the teams. And normally we see people who are left dissatisfied whenever they chose the wrong group. It wasn't a right cultural fit. It wasn't a right personality fit. There wasn't the right alignment there from where that business was going to go. Once the original founder relinquished control, essentially. So it's really critical, and I mean that's why we try to get to know our clients as well as we possibly can on a personal level. And on a business level, and really understand that culture of the business and what is the right fit going to look like. There has been some instances where we have clients where they probably would have made a different decision if they took a little bit different look at a couple of different LOIs. Maybe if they took a little bit less, they would have been a lot happier with the right partner for that earnout phase. Yeah.
It's kind of like a job. If you take the highest paying offer, it doesn't necessarily equate to the happiest job. I mean, there are some nightmare stories out there. I know of a business that sold to the highest bidder, and they took stock in the acquiring company. 5 years later, the acquiring company went out of business, bankrupt. And that was the highest price. They kind of ignored the potential factors that may not make that the best deal, and they took stock in exchange for the company because it was a tax-free transaction, sort of deferring the tax on that sale. So it requires a thoughtful approach, I think. So, and I said it earlier, like the private equity buyers, I mean, there are some phenomenal groups out there, right, that actually come in and like implement operational change to drive value in the company. If you retain some of it, they'll probably create more value in that stock down the road. There are some that are just financial engineers, that they're literally taking a bunch of small companies, throwing them together to make what looks like a larger company and sell it for a premium price. And that can work, but I feel like there's fewer of those players in the market than there used to be.
There is fewer of those players, but they're still out there, and we know just about all of them. So we're kind of ahead of the curve in terms of matching personalities and cultural fits with the right ones. But in addition to that, outside of private equity, I mean, there's still just such a wider pool in terms of buyers out there now. You have so many different independent sponsors and fundless sponsors, and family offices have just gone crazy the last several years. I was reading the other day that the amount of family offices out there have tripled since 2019. And when you really look at a lot of these family offices, they're essentially full-blown private equity shops. They're just as active out there making acquisitions and investments. You know, they traditionally have a much longer term hold period. They're not going in there and shaking up management. They're looking for, you know, long-term sustainable investments. So that's always a great option for a lot of our clients. We're seeing, you know, the family office be quite competitive than what they have been in the past.
I believe that. On a smaller scale, I've seen on the smaller deals where, you know, it's more about family transition and making sure that they're lined up for success and the business is able to continue. Sometimes it's not always just family. Think of myself as a CPA. We had our retired partners come in and they gave us the opportunity to continue the business. So sometimes it's another employee and a family member that continue the business, but I think a lot of sellers sometimes take pride in being able to provide those opportunities too.
Definitely.
Yeah, I mean, internal transitions, and we've helped consult with several companies about doing this. It's always great. I mean, if you can tee up an opportunity for maybe it's a family member next generation, or it's just, you know, loyal employees that have been with you for a long time, like those deals can be successful. They're not often the most valuable way to sell your business, but in our experience, they tend to be the most fulfilling way to transition the business if you find that this next generation is able to thrive in that. There is a lot of emotion that gets tied up when you start talking about internal transition, though, particularly if it's a, you know, son or daughter that might be taking over the business down the road. So there are ways to make it mutually beneficial, and time tends to be the greatest asset when you're talking about these types of transitions, because most loyal employees or family members are not, you know, able to come up with a significant amount to buy out the company right away, nor do they, or you probably want them to go to a bank, nor would a bank probably lend them the money to do that, to come up with potentially, you know, a 7-figure, 8-figure purchase price. And so if you're thinking about a internal sale, that it can be done. It can be done successfully, but it's very complicated and it requires a lot of advanced planning.
I agree with that. We're working with a group right now, and I put like a 10-year time horizon on it. It's a transition to the son. I'm like, listen, you got to start giving the son some responsibilities and get out of the way. And he's like, well, if I give it to him, I'm still going to be involved. I'm like, first of all, you're not giving. Second of all, you can't. Like, you got to let it go. Yeah. So it is the least profitable, but could be the most rewarding if done well. I think also in those situations, if you did things outside the business, so you have another set of assets, you're not solely reliant on, you know, little Johnny or Janie making sure your retirement's taken care of, and then God forbid there's Johnny, but Janie wants to buy the business and she runs it in the ground, and now mom and dad are broke.
Yeah, you run into a lot more family dynamics that way.
Yeah.
So how do you make it fair to everybody?
Yeah, it's hard.
Right.
It's hard, but can be extremely fulfilling to see your child do that. We've been going for about 45 minutes, so questions you guys have? Anything we have not talked about that you guys were hoping to hear? Hey everybody, Andy Reynolds here. Hope you're enjoying the video. If you guys have any questions, please don't hesitate to reach out to us. We really enjoy working with business owners. We like going through the challenges that they go through, helping them plan for the future. So we hope you've enjoyed the video, enjoyed the presentation, and please don't hesitate to reach out to us.
What sets you apart from other strategic planners / diversification? What sets your company apart other than?
Yeah, I think one of the biggest differentiators for us and what really separates us is, you know, we know who we are and we know who we're not. We're not Goldman Sachs, we're not JP Morgan, but we're also not the local or regional business broker. We really fall in between there, where we do bring that institutional quality with that higher level, higher degree of financial sophistication to the lower middle market that it's really tough to find. Especially in firms that have offices all across the country and internationally. Most groups out there in terms of M&A advisors are much smaller groups, and they're pretty industry specific. They only do healthcare deals, or they only do industrial deals. We're completely industry agnostic. We work on everything from manufacturing, distribution, industrial, healthcare, technology, food and beverage. You name it, we pretty much have worked on it. So that allows us to go out and really scour the entire market and cast that really wide net to really find every potential acquirer or partner or buyer out there. 9 times out of 10 when a client initially approaches, they always know exactly who's going to buy their business, and it's never that person. It's always another group that they never heard of, or these private equity groups that on their website they might list a couple industries that they're really hot on, and that's what their main investments are, but they look at all other types of deals as well. It really comes on to what's happening in the markets, and there's certain waves out there where a lot of these businesses are extremely attractive to a number of different buyers. So operating the scale and the magnitude in which we operate, I think really separates us.
So you come into play when all ownership isn't agreeable that it's time to sell. What are you doing when exit? Who plans for exit strategies for multiple partners, but like an individual wants an exit strategy, but the other partners don't?
Yeah, I think us. We can definitely help, but we've done that a lot. CPAs. One of my takeaways I'm going to end with is have a team. I think that's what we find really fun, is trying to figure that kind of stuff out. Depending on how big a company is, I'm sure you guys can be involved in those type of situations too, where maybe it's a founder who owns 80% and the founder wants to cut back parts of 40%. They want to sell that. It could be something you guys do as well.
Yeah, the majority of our deals have some component like that attached to it. Whether there's a majority owner who wants to take some chips off the table, he has a son involved, there's a partner involved. That goes on to our onboarding process and understanding what shareholders are, what is their role going to be at post-exit, what are their plans are. So we work on that all the time.
I think the answer to that would be a team of people. Everybody kind of looks at it from a different perspective. I think blending all those helps a lot.
Mm-hmm.
I do want to say one thing. We talked a little bit about post-sale, and this is anecdotal just from talking to a client recently. I think it is important. A lot of business owners, once they sell the next day, they say it's one of the most depressing days that they've had. They think they're running away from stress and they're running away from all the chaos in their life, but secretly they probably liked it. They actually liked getting up knowing that people relied on them and that they had people that, to come into an office, or to get on the phone with. And so I think, having purpose, for lack of a better word, or things to do, relationships outside of your business when you sell, it's critical. I've seen, and we see this with retirees too, it doesn't just happen with business owners. A lot of people work hard and, they deserve to retire or take a break, but it's not all it's cracked up to be if they don't have something that's fulfilling them. And that, that's, I just think it's important, because I think sometimes we convince ourselves that we're stressed, but I think we really like it.
And I think on that chart, those 3 paths, that's one of the ending paths. What are you going to do? You wake up, okay, you did all your things you want to do for 6 months. And we see this with retirees too. I had all this big to-do list, I did it, and now what? They're just looking in the mirror. So having that purpose is really important.
Tyler, what do a lot of sellers say about, I've always worked for myself and now I'm gonna have to work for somebody?
Yeah,
that I just met.
Yeah, definitely. It's certainly a transition, but there's a couple things to really distinguish there. We'll just make an assumption that it's a private equity group making the acquisition, and that owner's going to stay on for a majority of time. The the day-to-day and the regular operational aspects of the business and leading the team, most of that stays the same. You know, most of these private equity buyers, they want to find that owner-operator who's going to stay on and continue to lead the business. You know, where it really shifts is more on the governance side of the business in the back office. You know, making major CapEx decisions. You're going to have a board that you're accountable to now. You know, any type of dispositions or large purchases in the business, you have to run that by the board. So those are kind of the biggest things. But you're also getting a lot more support on the back office in terms of, you know, the accounting side of it. You know, things change quite dramatically in terms of those yearly budgets and those monthly forecasts, and you know, they're held accountable to those. But they're I wouldn't say they're bringing. It's not as rigorous as you know, publicly traded company in terms of the accounting, but they bring a lot of those same philosophies to it. They really professionalize that back office, and there's a lot more key metrics and key performance indicators that probably really haven't ever been in place in those types of businesses before. And there, you know, it goes to that, and then there is, you know, monthly meetings to determine where they're at on that yearly budget and where they're at on that monthly forecast, and there's quarterly meetings and annual meetings and stuff like that. It's certainly a transition, no doubt, but that's why it really goes back to finding that right partner. You know, we typically see it normally being a great match, and when the alignment's truly there, it's quite special. You know, they're hitting those metrics, that earn-outs come in, and they're staying on for that second bite of the apple, and it's pretty exciting. So it's really, really critical to find that right group, and that's what we're here to help you guys find that, you know.
Yeah. Fran, yeah.
Yeah, excuse me, how do you all structure, as advisors, your compensation? Is it percentages, is it hourly fees? Just, you know, out of curiosity.
We work for free. I don't know about you. It just depends. I mean, I'll speak for us and let you guys. It depends on what we're doing. You know, being an independent group that we are, we have the ability to structure things differently. I'll let you talk about the two, kind of, you several, but some unique things. But we can do consulting work. A lot of what we do are high net worth individuals, families, business owners that we work with. Obviously, we manage assets. You want to chime in?
I mean, right now we're doing one, and it's just a 6-month monthly retainer, and we're doing that where it's essentially a intra-family estate planning business transition, and so we're structuring that for the family. So we're interviewing all the family members and trying to come up with a mutually beneficial structure on how we're going to do this. And so we'll architect this from a very high level, and then we'll bring in the pros to execute and the lawyers to draft the documents. So, but that was a new relationship, and so an existing relationship, if we're already handling their picture, you know, handling their assets, we might do that as part of our service.
We do a lot for what we do for managing an account. We probably overstep a lot, not overstep in a bad way, but overserve is.
I don't know. I mediated a divorce one time at a conference. That's not on our list of services.
We're entrepreneurs at heart, so we like I mean, John's represented a beneficiary of a trust, you know, very large trust. You know, we've business owners where they don't have 401k assets, they don't have individual assets, they're in the infant stages of their business. We work on a consulting agreement. So it's really depends on what the people need. I'll let you guys.
Yeah, ours is very straightforward and transparent. We have a one-time engagement fee. Depending on the size of the business, that could range anywhere between $20,000 and $50,000. Typically falls on the lower end of that. We put 10 bankers on every deal. So that initial cost is really for our clients to have skin in the game. You know, if we didn't have that charge up front, you know, we would have every business coming to us wanting to run the process and put it on market. And then we have a percentage of the transaction at the close, which is typically 5 to 6%. of the total transaction volume, and that's it. We don't do any type of monthly fees or anything like that. It's really been designed that way, and having that upfront fee and putting all those bankers on for all that prep work that I mentioned earlier. And our engagements are extremely long in the industry. We sign up and, a client on boards with us, and we commit 5 years to them. Our engagements are for that entire time. So our approach is pretty unique in that aspect, because we're not going out and chasing the market. We're going to prepare all the material, get it ready. We might see the market shift a little bit and say, hey, let's pull back a little bit, or you're having some management issues, or there's a fire in the warehouse or something. Let's hold off a little bit, wait a year, wait 6 months, and pull back. Or if we want to adjust some earnings and hit certain hurdles before we bring it back on market. So we're committing that 5-year term up front. And then, obviously a client could hire us today and fire us tomorrow, but we're making that long-term.
And I'll tell you, that's rare, because a lot of these business brokers, they're looking for the quick transactions, so.
Yeah, we're not out chasing the market.
I didn't know that you all did 5 years, that's great.
Yeah, that really separates us in the market.
Our fees are for existing clients, we just charge our hourly rates. If a new client comes to us and wants us to consult, run scenarios for them, there would be an onboarding fee up front, depending on projected times and stuff like that. But
Any other questions? Anything you guys want to end with or chime in that you haven't had a chance to share?
Well, I mean, all I would say about our company, if you ever wanted to start the conversation, we're no pressure. I mean, we want it to be a mutually beneficial fit, and we're in this for the long haul with people. So, and I can't speak for Andy and Tyler, but I think, we want people to do business with people they want to do business with, and sometimes that requires kicking the tires and interviewing multiple people to do that. So I would just encourage you, and when we have new people looking at us, we often encourage them to talk to others, come back to us, when you're convinced we're the right fit for you. So I would just say, we don't start the meter on cost with people when the phone rings. We want to make sure that it's a fit, and oftentimes that takes a few meetings.
Multiple,
Yeah, we're the exact same way. Mostly when we onboard a new client, they're motivated, they're ready to exit, and they're ready to start the process. But we've had some form of discussions and sat down with them and meetings with them a year or two in advance. We want to try to be a valuable asset to you folks, where if you just have questions about the market or what type of multiples we're seeing in certain industries or sectors, we're more than happy to pull those reports and research and let you know what type of case studies we're working on or past transactions. Feel free to reach out anytime. We're always available for a Zoom meeting or an in-person meeting just to talk through the M&A process and what we're seeing in particular sectors.